I think even by looking at the number of you here, should give you a representative. There are over 50 first licensed ones. Then add the traditional banks because they are also starting going into the digital space to give the mobile loans. So there are multiple hundreds. And not only the licensed, look at the unlicensed, look at the Shylocks. So the consumer has all these opportunities to borrow. What's happening? Because of the pressure that they are getting in, you'll find Peter borrowing to pay Paul. You'll find somebody who's trying to build up or even defraud, get different numbers so that they can borrow as many times as possible. You've given me a limit of 1,000. I get 5,000 from this one. I get 2,000 from this one. My target is to get 10,000 to survive the month. So what will I do? I'll apply from all of you at the same time. And 3 months down the line, you have a non-performing loan in your book. So looking at this consumer then, you as a lender, what do you need to do to be able to thrive and survive? Because you have to balance the risk and the cost plus being able to do business. So it means that you have to relook at your customer journey or the credit life cycle with new lenses. Look at every piece from targeting all the way to collections with new and better and more predictive ways of being able to see this consumer in a 360-degree view with information that you have within yourself plus other information that you may not see within your own environment. If you're a lender A, for example, and you know Anne has a limit of 5,000 that I have given her, it's highly critical at this time to be able to understand what is Anne doing out here in the market, that you can be able to see Anne has 10 other loans, the limits that she has, is she paying well, is she paying not well, to be able to target the right customer from the acquisition stage or the targeting stage. So you need to set the right strategy for targeting, meaning it's not a game of going just for more, it's a game of going for the right customer. Being able to identify from the crowd who is the right customer that I need to go to or to go for, so that in the entire credit life cycle that I have this customer in my environment, I make money and I make the best out of this customer, because the agenda is to give out this money and still get your return and get back that shilling. When you look at acquisition, time to money is critical, and I love because we are all in the space where we are meeting the needs of the consumers, being able to get my loan at the click of a button, application to disbursement. I don't need to visit any brick and mortar bank like before. But that means you need to make sure that your KYC, how you verify the customer that has come onto your platforms, how you do your credit risk analysis, it's all very predictive and also within the short time that you have. So being able to mitigate the risks while you're still doing business, booking more business and faster, being able to do frictionless onboarding, that becomes critical at your acquisition stage. And when you have already gotten this customer in your environment, it means you need to see opportunities of what to do more with this customer. If you booked a good customer, then you need to see the opportunities to cross-sell to them, to upsell to them. You may have started me with a limit of 5,000, but 5 months, 6 months down the line, I'm good for 10,000. Or I could be a candidate to be downgraded to a limit of 2,000. But how will you know that if you're not looking at the entire environment of how I'm behaving and looking at my 360-degree view, using data, using other partners that you can work with, and looking at the whole customer. And finally, in terms of the credit journey, in terms of collections, being able to collect efficiently, because remember, once the money has gone out, it has to come back for you to be profitable. So what I'm saying is, this is a customer lifecycle journey that you all know. And there are things that we have been doing in our environment, in our businesses, to ensure that we are making money. But I think it calls for a different way of looking at it, a different way of looking at all these stages and saying, what can I do differently at targeting to make sure that I'm getting the right customer? What can I do at acquisition? What can I do at portfolio management? And all the way up to collections. And that is what I'll be showing you in terms of how you can leverage what we are calling credit vision trended data. So let me give you a picture of today. When you pull a credit report today, you get my information as it is right now on the date you have pulled. My information, for example, my score. You'll get the score that Anne has right now is 500. You'll get my loan balance for the different loan facilities I have. Let's say it's a personal loan, a credit card. You'll see my personal loan balance is 5 million, credit card of 50,000. I have maybe a mobile loan of 10,000, maybe 3 of them. So you're getting static data of what my picture looks like today. What I'd like to introduce you is the power of trended data, or using algorithms that we have developed to show you the whole picture of this customer, how they have moved or how they are moving from the last 24 months, and then you can be able to project or be able to see where is this person going. Are they improving? Are they going down? So let me give you an example. You have Peter, Paul, and James here. Imagine there are 3 people standing next to me. We have pulled a credit report, and this person right now, their score is 500, right? Now, if I told you, for example, that for John, 3 months ago, his score was 400, then it moved to 450, and now he's at 500. Then for Peter, he's at 500, but 3 months ago, he was at 700, he moved to 650, and now he's 500. What does that do to your decision? Or what does that do in terms of projecting the journey of where these people are going? Are they going in the same direction? Are they going in the same direction? Totally not. And look at that in terms of all the parameters that you look at in a credit profile. It could be the arrears, it could be the balances. I'm just choosing a score for demonstration. So if I'm able to tell you that yes, today, Anne is 500, but Anne is on a downward trend. The 500 could be your benchmark. It could be your cutoff, right? So I meet it. But if you're able to see that with trended data, this Anne is going downward, so in the next few months, I don't even have to do anything to know that Anne will be at 550. Will be below my threshold. You're able to make a decision that is better than when you're only looking at the static data. When you're able to see that Anne is on an upward trajectory, then you're able to know this is a good prospect that I need to go for. If it's balances, let's say, for example, let me use a credit card. We have 3 people here, Mary, Anne, Susan. Our limit is 50,000 credit card, right? With trended data that we have, we're able to show you the utilization that Anne, yes, has a 50,000 credit card limit today. But if you look at my last 3 months, my utilization in that credit card is actually 200,000 because it's a revolving facility. I'm able to get 50, pay, get another 50, paid. So my actual utilization, my actual amount that I have used on that credit card is over 200,000. There's this other Mary who also has the same limit of 50,000, but the maximum they use of that credit card is 20 or 40,000. Are we the same? No. But with current static data, what you get is the assumption that we might be the same because you're looking at the point in time. So the importance of this is that we are able now to show you the trended data of this person, where they are going in their journey, using, for example, the last 24 months, for you to be more predictive as you make your credit decision on what to do with this customer, whether in terms of limits that you're giving them, in terms of their scores, in terms of their repayment ability, or the history in terms of default, all that information. It becomes very critical in the current environment because of what I have just said has happened. The consumer has changed. In the last few months, a lot has happened. Many of the consumers' ability, disposable income has been impacted. Many were also impacted by the credit repair framework. And many of the lenders also ask, how do I know a consumer who was impacted by the credit repair framework? Because the reason you're asking that, because you're looking at static data right now. But if you're able to see the trend behind that person, you'll be able to quickly isolate and say, this person moves from 400 score to 700 in a period of 3 months. What happened? Or this person has moved from 700 to 300. What happened? So you're able to identify that very quickly. In general, what trended data gives you is gives you first the general information of this consumer, the revolving ability, any revolving products or solutions that this customer has, be it mobile loans, be it credit cards, those that mean I can take many times. The limit could be the same 50,000, but over a period of 3 months, I may have used 3 times that limit or 5 times that limit, or somebody who doesn't even maximize on that limit. It's able to show you that. The payment behavior, how much am I paying? Even the payment ratios, am I paying 50%? Do I pay 75%? Do I pay 100? Or even do I overpay or prepay? So this is information that we are able to show you with the trended data, including the balances, like I've given you the example. Those people whose balances are increasing, those who are worth more, and including even the wallet share of these customers. I see people are taking notes, but I believe this is information we'll also be able to liaise with Susan and share with you for future reference. So in short, what I'm saying, because I see I have only 5 minutes left, the consumer has changed and have painted for you the picture. Our working style has to change. And one of the possible ways that we are recommending to you today is the ability to use trends, not just relying on the traditional static data that you get or the information that you have within your environment, but leveraging data analytics and trends and algorithms that will help you know where your consumer is coming from, where they are going, therefore making you able to differentiate very precisely and not just using imagination or with data that this is the person I want in my environment or this is a person I don't want. This is a person or the consumer who will be profitable. This is a consumer that I can increase the limit for or not. So you're able to get richer insights. You're able to score better. So there are customers or clients among us here who have their own internal scorecards. When you're lending digitally, one of the things you need is a scorecard because you're not sending people to the... Before when I was in the bank, we would send people to do call visits, look at the stock in the shop, look at the location where this person is, to do the 5 C's of credit, right? In the digital space, there is no time to do those physical visits. So you need something that will help you make that decision as you would have made in the previous time, but using analytics or scorecards. So you need a very predictive score. And one of the things you can do to leverage, even if you're using your internal scorecards, is to leverage alternative data or trended data that you're able to provide with you. That is not just static data, so that you make your scorecards more predictive. And finally, efficiency becomes paramount in these times that you're operating in. Making sure that this is seamless. It doesn't delay your customer journeys. It doesn't delay your onboarding or acquisition journeys. So this is something that you're able to leverage on within your existing environment. We're able to give it to you via API. You can also get it offline if you want to do some proactive analytics before you lend. So in short, what we are telling you is this is a possible way, one of the possible solutions to change your working style so that you can survive the burning bush and you can thrive and continue to make money. Thank you so much for listening to me. I see I have 2 minutes, so I can take maybe one question. But this is just to set the pace. The next speaker who will come after you will show you real case studies of how different players, different fintechs in a different market are leveraging the same kind of data to make money, to make decisions, to be able to make robust and very predictive decisions as they learn. So I will invite you for a 15 minutes refreshment break. And then after that, we'll come back to the next speaker.